Okay, purchase returns. First of all, you have to know the four main reasons for purchase returns. What's the most common one that I say? Wrong specification. Good. What's another reason that there's purchase returns? Overstock, damage, faulty, any of those sorts of things. What is the source document for a purchase return? Credit note. And how do I know that it's a purchase return credit note? Correct, it'll have the supplier's name on the top, not our name. It'll have the supplier's name and it'll be to us. I'll give you a chance to write that down. Why do we need to have a credit note? Tell me a quality characteristic. Beautiful.
Yes,
and when I return items, at what price do I return them? The cost price listed on the
credit note.
On the credit note. So when I do my stock card, the purchase return, the credit note will tell me how much I'm returning it for. Okay? Because we only deal with cost prices when we're doing purchase returns. Okay? So it's different for sales return. I'm only doing purchase return notes today. Alright, any questions there? Yeah. First of all, when we record it in the stock card, is it going in the in or the out column for a purchase return? It's going in the out column. I want you to write the notes.
That's what I said.
Oh. As well as recording it in the stock card, and we record it in the stock card because we use what inventory system starting with P?
Perpetual.
Beautiful, well done. Hello YouTube. Perpetual inventory system. Because we're using the perpetual inventory system, it's ongoing. As soon as there's a purchase return, we update our stock cards and it goes in the out column. We actually also have to record it in our journals, in our ledgers. Which journal will we use? The general journal. Why do we do it in the general journal? It's not a cash receipt or payment. It's not a credit sale.
Too many columns. Infrequent, non.
Exactly. It doesn't fit in any other journal, so it has to go into the general journal. Okay? The entries for a purchase return are always the same. Counting bingo tick. Okay. Debit. Creditors control. Why does creditors control get a debit? It is decreasing the liability. Because we've returned the stock, they've given us a credit note, we don't owe them for it anymore, it decreases the liability, that's why it's a debit entry. Also, the subsidiary ledger also gets a debit for the individual creditor. The debit entry is for the full amount owed, the price of the stock and GST. Okay. So that's the debit entry. We credit stock control. Why do we credit stock control? It is decreasing our stock. The stock has left, therefore we have to decrease it. We also credit GST clearing, because originally when we had the sale we would have debited GST clearing because we would have decreased the liability. We can claim that from the government, and because we've returned the stock we can no longer claim it for the government, so we have to put it back. So that's why it's a credit of GST clearing. So it is easier to do a purchase return than a sales return because there's only 4 things to fill in. Okay? Purchase return 4. If we did a narration, what's the first thing we always put in our narration? The source document, which is not a memo, my friends. It's a credit note. In the memo, in the narration, we put as much detail as we can. We would put the quantity, so we knew how much stock was gone. We would put the stock type, and we would put the reason. So we put as much detail as we can in the narration, so that when the person's doing the ledgers, they know why we're doing the entries we have to. All right. Any questions there? Okay. All right. Let's do the ledger accounts. So you need to draw yourselves up. Draw up 4 ledger accounts. Give yourself about 4 lines for each of them. 4 ledger accounts. Stock control, GST clearing, creditors control, creditors subsidiary. We're recording again. So, first of all, a normal stock control account will have a balance on what side? Debit side. So let's put an opening balance in. When we bought the stock, it would have also gone on the debit side. What would the cross-reference have been? Start with stock control because we're in the stock control ledger. Start to see. Creditors control. Let's buy $5,000. Then during the period, we sold some stock. What would the cross-reference be? Doesn't matter if the cross-reference is the same. So say we sold $3,000 worth of stock. In our GST clearing account, what side normally will the opening balance be on? Generally on the credit side. If the items that I sold during this period were for credit, and to make our lives easier, we'll assume that it's 100% markup. So if the cost price is $3,000, what's the selling price going to be? $6,000. So what's the GST going to be on it? $600. What side would that go on? The credit side is correct. What will the cross-reference be if I sold it on credit? Very good question. I sold it on credit.
There's control.
Debtors control.
Oh, you're.
If I bought stock on credit, I claim that GST back, what will the cross-reference be? I bought stock on credit. Credit is control. If I bought $5,000 worth of stock, how much would the GST be? Yeah. All good to there? Everyone understand where the numbers are coming from? Okay. Let's go down to our creditors control. You won't have an opening balance. We'll just start that we didn't have any stock and we just bought some during this period. Okay? So if that happened, what side would it go on?
Credit.
The credit side. What will the cross-reference be?
Stock control plus GST clearing.
Beautiful. So, how much from buying that stock would go to creditors control? If the stock I bought was 5,000, the GST was 500. 5,500. And let's assume it'll be in the purchaser's journal, so we use end date, but in the purchaser's journal, let's assume that we did it on the 17th of January, because we use actual dates, remember, when we do the subsidiary ledger. Actual dates in the subsidiary ledger, which remember for an exam. The cross-references in the subsidiary ledger are exactly the same. Exactly. Alright, so every entry that we've put in so far are all the entries before a purchase return, yeah? We all good there? So let's go back to the top. I'm going to do my purchase return entries in a different colour, just to highlight them. Okay. The entries for purchase return are always the same. Debit, creditors control. So I go down to my creditors control and I write on the debit side. What will be the cross-reference in the creditors control account? Stock control / GST clearing. Now, let's assume for this question that we didn't return all the stock. Let's pick a number between, well, that's between 1 and 5, because we bought 5,000. Less than all of it, in between. 3. So therefore, how much will go into creditors control? If the stock is 3,000, GST would be. So therefore, the amount claimed back will be. Alright, so that's the purchase return entry. Creditors control, debit entry, the stock, and the GST clearing together. That's the first one, tick, from the general journal. What's the second thing in our general journal we have to deal with? The subsidiary ledger. So it'll go on the same side, actual date. Let's say it happened on the 23rd. What's the cross-reference going to be? Exactly the same. Stock control / GST clearing. That's half the entries done with them. It's done 2 out of 4.
Come on.
What's the next entry?
Stock control.
Stock control. What side are we going to write on?
Credit.
So go to the stock control account. Go to the credit side. End date. What's the cross-reference going to be? Creditors control. Well done. How much for? Just the 3,000, because this is the stock account.
Doesn't that affect cost of sales? Can that go down?
A sales return would, but not a purchase return. Because remember, a purchase return, your entries originally were that one. So that's the original purchase, that was the original entry, that's the return. Cost of sales is only affected when there is a sale. The cross-reference for this one is creditors control. The last entry is to go to GC clearing. On what side am I going to write on? The credit side. The cross-reference is the name of the other account affected. Beautiful. Creditors control. 300. So what you need to do and what you need to practice is make sure that you know the general journal entries, which are always the same. Debit creditors control, subsidiary debit the creditor, credit stock control, and credit GST clearing. That's what you have to remember off by heart. From a T ledger point of view, you've now got to realise that you can have creditors control on both sides. This side reflects when you bought stock. This side reflects when you've returned stock. Yeah? Does that make sense? We all good up to there? Alright, next stage. Always they ask what's the effect of a purchase return on the income statement. The way to know the effect is to go back and look at our general journal entries. Because these are liabilities, that's an asset, and that's a liability. So that hints to you what the effect on the income statement is. What's the effect on the income statement? No effect. There is no effect from a purchase return because it's just a movement of stock from buying it to returning it. So there's been no revenue or expense during that time. What is the effect on the balance sheet? Well, let's look at our assets first. What happens to our assets? Do they increase or decrease with a purchase return? They decrease. And obviously, if the question tells you the amount, you will put the amount as well. Danny should be writing this. What do liabilities do? Do they increase or decrease? Decrease is correct. There are two liabilities affected. Creditors control decreases and GST liability goes up, but creditors control goes down by more. So the net effect is a decrease. Owner's equity, no effect.